We're live. Hi, Paul. Welcome to Venture with Grace.
Venture with Grace. I want to let everybody know that the way you get on Venture with Grace is you run into her at like midnight walking down the street. That's
Oh
how
my
you
God.
get invited. That's how you get invited on Venture with Grace. I think it was about midnight walking down by
No, it
the.
was like low-key 8 p.m. So it was
Oh, it
definitely
was
not
only 8.
midnight.
Oh, it was only
Yeah, it
8.
was
Okay.
only 8.
I
So
might have been jet lagged from the East Coast. So there you go.
yeah, you look very you look like you were like onto something the other day. So like I feel like it was. I don't want to like bother you for like over like 25 minutes or something, but it was fun to run into each other on the street in San Francisco. But
Yeah.
anyway, so I feel like you have such an interesting journey. As you know, I just listened to your like 13 years ago conversation and 8 years ago conversation with some of the great podcasters, and I wonder like, so I think like you have established a company with like Mark Pincus before,
Oh, yeah.
and like, and I feel like a Bullpen have like a really interesting position as like you are looking for founders that already like meet product market fit and that already raised from some people, and you are doing some sort of like, I don't know if you call it seed extension or like some sort of like the round that's like kind of like right before they um got accelerated by like the next round of funding. So why don't we start with like, your journey early on? How do you meet Mark Pincus, or like how do you kind of start at 8 company in a row to like, how do you kind of like come up with a thesis for Bullpen Capital? Let's start there. Sorry. Like I'm just like,
Oh man, right? Like, I mean, that's a lot, Grace. So I'm now a 9-time founder now. So this will be the first time I think I've done an interview now that I've
Mhm.
started my 9th company, which launched a week ago.
Oh wow.
So I'm on 9, and Bullpen was 5. Tribe
So
with Mark Pincus was 3.
mhm.
Bullpen was 4. And so I've done a venture fund, I've done a social network, I've done a game company, I've done a sports betting parlor, I've done a nightlife business, I've done a movie studio, you name it. I've done pretty much almost every kind of
Everything
company at this point.
entertainment. It's
Yep.
entertainment driven.
Yeah, a lot. It's turned out that a lot of my stuff has been at the intersection of live events, entertainment, gaming, sports,
Mhm.
etc. And so I do
Mhm.
feel like that I have an affinity for that. But I met Mark Pincus via Matt Otko. Have you ever had Matt from DCVC on your show?
I definitely want to have him. We had another investor from DCVC, Alan Cohen,
Yeah.
within
So
healthcare. Yeah.
Matt started the fund with Zach Bogle a while
Mhm.
ago, and Matt's been a friend of mine. My first weekend in Silicon Valley when I was still in grad school, I was at
Mhm.
Otko's house, and he told me we're going to be friends. And almost 30 years later, he's one of my best friends in the world. He
Mhm.
introduced me to Mark Pincus, and you know what he said to me when he introduced me to Mark Pincus? He said, "One day you two will start a company together." And I remember we poo-pooed it, and years later we started Tribe together. So Matt is quite a forward thinker.
What was a vibe that like he was sensing that you guys will be like great co-founders?
I just think I was highly technical at that point in time, right? At that point in time, I was a really hardcore technician. And I think he felt that that would be a good fit with Mark, and Mark being really kind of a visionary type
Mhm.
founder, me being a kind of more, even though I've done 9 different companies, I've always been the adult in the room founder,
Mhm.
and Mark's the crazy founder. And so I think that Matt properly sensed that that could be a good partnership and balance. And you go look at the founding teams Mark has had in his other companies, there's tended to be that very interesting balance.
Mhm. Wow. I like that. I wonder, so like from your experience of like starting venture fund and like recently another company literally last week, what were like some core lessons that you took being like a serial entrepreneur?
By the way, this is super funny. I'm not, but it's got me listed as chairman River Horse Pack.
Yeah,
Make
what is
no
that? Like I
ma- make no mistake, that is true. But the fact that today is the election and it's pulled my credential from a pack I run as opposed to from Bullpen Capital, right? This is what happens when you have 20 logins. It grabbed one and gave me that credential. So there we go.
Oh wow. What is Sherman River House Pack? Am I supposed to
Ri-
know?
River Horse Pack is a pack I run that's involved in politics. So
Oh, okay.
that's a topic I don't feel like talking about today,
Yeah.
since everybody else
No,
will.
yeah, like,
But
this is not a
ironically,
political
they're
show.
gonna
Please
think
don't
I'm
cancel us.
talking. Right, Grace, this is the thing. Ironically, they're gonna think that that's what we're talking about. See, they're trying to make us do it.
Oh gosh. Actually, let's not cancel ourselves today, but let's focus on like the venture stuff. Okay,
That's what we're
so
here for.
amazing. 8 different companies, like including some funds, and like let's talk about like, what were some like things that you've learned throughout the years?
Well, I'll tell you one I learned most recently is CapEx is for
Mhm.
suckers. That is definitely my biggest lesson learned from my 8th company. Bankroll was a very expensive lesson in that CapEx is for suckers, because building physical build outs is very, very expensive. It is time consuming. It is subject to zoning and restrictions, etc. And so that is definitely one of the lessons I've learned. Another lesson I've learned, Grace, is that every company is the same and every company is different. I remember when I did my film studio, I realized that almost everything in the film production process had an analog to a tech startup company. The script was like the product, right? The CEO was the director, the fundraising, everything had an analog. And what's cool is at some point, once you've done enough different businesses, you really do get that point of view that every business is different, but the fundamentals of what you need to do in each one is the same. And that means it's very teachable, very coachable, and very mentorable to the next generation.
Wow, that's I completely agree with that. I feel like there's a lot of like analogies throughout different industries. Um I think like one of the things that I found really impressive is like I feel like creating consumer products slash like regardless if it's like sports betting or like investing in companies like Ipsy or Spot Hero, like anything involves the consumer. I feel like there's like some sort of like art and science to it. Um, how do you like kind of like actually capture consumer attention? And what does that translate into like product building and building a team or in using your analogy, like running a business?
So that pre-product market fit for a direct-to-consumer company is one of the most miserable places you can ever be in. I've been on that board, I can't tell you how many times, Grace, where you go to the board meeting, you're like, do we have anybody yet? And then you go to the next board meeting, do we have anybody yet? And then sometimes you never get anybody. And then sometimes you have that magic board meeting where like, yeah, dude, everybody showed up. What am I going to do with this demand? But those board meetings before you have product market fit on a direct to consumer company, they're the most miserable board meetings you could ever be in.
Why? Like, why
Be-
is there like
because
nobody on board?
you're waiting, and this magical thing is going to happen. And I don't care how many product innovations you have, there is some magic that happens that is unpredictable and unknowable and unplannable. And you don't know if you're 2 inches away from it or 2 years away from it. Enterprise
Um,
companies are different, right? Because you have
yeah.
more traditional go to markets,
Mhm.
you have levers you can use, you can call the analyst, you can get Gartner to write up the articles, you can brief right. Direct to consumer, does anybody give a crap? Yes or no, like a light switch.
Um, but why do you keep starting consumer companies?
Well, I enjoy it. I actually enjoy all kinds of companies. And I would say that consumer ones are more difficult because of that very binary, the dogs are eating the dog food or not. And of course, you can advantage yourself by having really good product designers. You can advantage yourself by going into spaces where there's a lot of attention and built in audience. Make no mistake. But there still is always that white knuckle moment when you release the product and you ask yourself if anybody downloaded it or used it or viewed it or watched it or whatever the metric happens to be.
Um, what's your thought process on like investing in the consumer companies? Like, like you mentioned, like, you guys look for after product market fit, after like a certain investor enter the room. Um, and like, right before they have like a really major growth metrics happening. Um, how do you kind of like spot these kind of like consumer companies? Just because I feel like a lot of it were, like you said, like unpredictable.
That's right. And so we wait for early product market fit. And I think this is one of the things that Bullpen's really figured out how to do. We know how to invest once the earliest bit of product market fit on a consumer company is there, whereas the more traditional Series A investors want to see that couple quarters. You give me 2-3 weeks of showing me something that's working, I might be pretty excited to jump in. Whereas I would say the traditional Series A investors want 2 or 3 months or 2 or 3 quarters, giving us at our post-seed fund Bullpen a chance to front run them by a round, which is basically what Bullpen does.
Can we talk about like your sourcing strategy on that?
That's great. So we're interviewing associates and analysts right now, where I've been doing job interviews all week. And I give the following statistic in every one of the job interviews that everyone kind of sits there and goes, what? So we've done almost 150 deals in the history of Bullpen. And in the traditional sourcing sense of venture capital, 3 of them have been sourced in a traditional way. 3. The other 147 of the deals are inbound. Inbound from the prior investor, directly from the CEO, or even in a couple cases, a cold freaking mail on LinkedIn. Now, you tell me how many venture people actually respond to cold emails on LinkedIn. We actually do at Bullpen. And I think that's one of the secrets to our business model. And so in 150 deals, only 3 deals were sourced in what I call a traditional way. What that means is we have a different product. We give a different value proposition back to our CEOs. We invest at a different stage and target companies that look different than the rest of the ecosystem. We are not an undifferentiated fund with an undifferentiated service or product. Bullpen is a unique thing, and people who need it come find us.
How do you sit through for each of your 150 company that you have invested in, I'm sure you will sit through like a 5,000 company that like look adjacently similar.
Yep.
How do you like quickly be like, okay, so this company makes sense? Oh, of course, there's like the traditional benchmarks on like what did the CEO done, like how big's the market, like whatever everybody else use, but like what are some like unique things that you feel like are making the most major differences?
So I will tell you, again, being in the interviewing process, our analyst job is the coolest analyst job at any venture fund. Because most analyst jobs at venture funds are the partner likes a deal, go do the diligence, go write the memo. Our analyst function is the front of the funnel that sifts through everything. Literally, if you're going to take all comers and you have a really broad funnel, you need to have a crackerjack analyst team to figure out where the signal is. If you're going to listen to a cold email on LinkedIn, you're going to need to be able to have an analyst team that can sift through that volume of data. That makes our analyst job super fun because they are the front of the spear. They get to see everything and figure out what are the things that we need to pay attention to, as opposed to just writing memos on the back end, which is what the analyst job is at a lot of venture funds.
Like, do you teach them anything, or like do they just like go freestyle? Like after let's say
No,
5,000 back, you
we have a very specific boot camp for how to spot a Bullpen deal. It's actually not that hard, and it doesn't take months. It does take reps, right? It does take where did this come from? Who's the prior investor? Where's their ARR? Is it direct to consumer? Like, it takes some reps, but I can teach an analyst how to be a good front of the funnel person and give them the reps on it within a month. I would say that most of our analysts are capable of doing the proper screen within their first 30 days of work.
I guess like what does it kind of look like? You mentioned about like the ARR or like some of like the hard metrics, and like there's like some sort of like I guess indicators as like who lead their last run and like stuff like that.
Yep.
What would be like a good ARR for the company that you have invested in? Obviously, I'm sure like B2B SaaS and consumer are very different, and like dev to is very different, AI is very different. What are some like metrics that you would be looking for in these things? Of course, say whatever you can.
Oh, sure. Let me give you a couple. So there's some obvious ones. So some ARR and some download number for direct to consumer. Forget about them. Some of the non-obvious ones I think are the ones that are interesting. Number of employees. You'd be amazed how predictive number of employees is to the actual state of the business. Burn rate, also very predictive of the state of the business. prior financing, total cumulative, age of the company, and enterprise software, how many SDRs? Is it all founder-led sales, or do they have one salesperson? In direct to consumer, what is the configuration of the marketing team, or is it all product-led growth? So there's some really cute, interesting things that in a 5-minute phone call, you can get an idea of real product market fit. And while I haven't given you kind of any of those answers, the fact that all of those are signal gives you an idea that it's a pretty easy way to get your head around if this company has achieved some product market fit.
So what would be the ideal number of employees? I feel like right now with the help of AI, like, the number of employees in your company could be like 3 people, but you could achieve a lot more stuff than the past. Like, I wonder what does like the ideal number of employee kind of look like for like a seed stage company?
So I
Do you
will
think?
tell you this, prior to AI, Grace, I think your question is very prescient, and I think the answer is going to be different. We have a portfolio company right now that's one of our best performing companies that has gone from 4 to 6 employees and from 1 to 11 million in revenue over the 18 months that we've invested. That is very unusual, but it is a very unique company, and I won't go into the details of it, but it is in some ways a post-AI company in terms of efficiencies, etc. But in general, that is an outlier. Most of our best companies have somewhere between about 12 and 18 employees when we invest. We give them money for 18 months, and they're somewhere around 40 to 50 by the end of those 18 months. And there's a certain shape of that. They usually hire their first HR person during the course of our money.
Mhm.
They go from an outsourced CFO to an in-house CFO. So there's some really interesting hallmarks of the company as they grow up. Now, will
Mhm.
that 12 to 18 move to 6 to 12 because of AI? I don't know, but it is certainly possible.
You also mentioned about like burn rate.
Mhm.
Uh, what is like a good burn rate? I mean, of course, as less as possible, like as less as you can burn. Maybe that's not like the best benchmark because you actually want to spend money to grow your company too. Um,
Exactly right. And this is why I say this is counterintuitive. So companies that are truly break even sometimes are very difficult to get your head around product market fit because they could have so subscaled grown because they didn't have the cojones to go invest in marketing.
mhm.
Um, most of our best companies, they're burning around 150 to 200 because they're making enough investment in personnel, product, and marketing to be ahead of the curve of growth. Our companies that are burning 4 or 500K, that's too much. We won't invest in them. And if they're burning zero, we will sometimes, but we need to see a different plan that's going to actually increase the burn in the short run because we need to see them actually making investments.
Um, does this like I mean, I feel like also depends on like what type of companies, right? Like so for 100 to 200 150 to 200K monthly
Yeah.
or
Mhm.
okay.
Yeah.
So where would you encourage them to spend money on? Is that like as you mentioned, of course, like hiring the HR, the CFO, and then there's like the marketing side of things. Um, just say like using enterprise SaaS as an example, like would you encourage them to like add more people onto the product team or like the marketing team? Like what's the is there like any generalized advice that you would give to the portfolio founders?
Most of our enterprise software companies have their first successful sales pod. They're no longer all founder led sales because that's kind of a no no for us. But they also haven't scaled the sales team. They figured out one pod and they want to go from one pod to 4. I love investing in going from one sales pod to 4. I know how to do that. I know how to coach that. I know how to help that company. I also know that if they have one operational pod, they figured something out around the sales process that's non trivial. So that's a perfect example of the kind of thing that we look for, Grace.
What is a pod? Is it like 3 people in a SDR team that's
It
called a
can be
pod or like
it,
what's the vibe?
it can be any number, right? It can be two dialing for dollars reps, one account executive and one customer success person. That could be a pod of 4, right? It could be one person dialing for dollars and one customer success person because all the sales are done online, right? I've seen it all over the map. right? So most pods are 2 on the low end to 4 on the high end. And once you see it work, you go, okay, Paul, my pods are 3 to 4 people. I want to go hire 12 people. It costs me this much to hire those 12 people. So I want to do a $5 million round with you. I'm like, yeah, yes, you've passed the IQ test.
What about like prior financing?
Yep, that's also very telling. Companies that have only raised, call it $500,000 to $1 million, tend to be too early for us because they haven't really invested in some of the things we need to invest in. And companies that have raised more than kind of 8 or 9 million have raised too much money for us. So our sweet spot is kind of like 3 to 7 million in total financing across the lifetime of the company. And stuff that's below that and above that usually falls outside of the bullpen zone.
What should they be investing before you guys join?
They should be investing in product. They should be investing in product market fit. So we want Duncan Davidson, who I started the fund with, he likes to call the bullpen round the build round, right? He's like there's the product market fit round, and now it's the build. Now it's invest. It's the first go to market kind of rinse and repeat. So somebody got out of inception stage. We are now into investing in accelerating go to market. And that feels very, very different than investing in, this is a product that I'm building. Let's hope somebody cares.
What kind of like from like a fund perspective, like how does your like kind of portfolio construction look like?
So as weird as our fund is in terms of kind of the companies inside of it, in terms of the stage at which we invest, and maybe what some of our founders look like, our fund is as traditionally organized as any fund. We have a 1-to-1 reserve strategy. Our funds do 20 to 22 deals. Our funds are 125 to 150 million dollars. So from a portfolio construction standpoint, it's one of the only things that is truly plain vanilla in our funds, whereas everything else is a little bit different.
I wonder, like, what are some, like, you also mentioned about like the age of the company. Um, is that like the people's age, or is that like just like, oh, this company's like fun 3 years ago?
Oh, yes. It's not the age of the founders. No, that's not it at all.
Okay.
It is literally the age of the company. So I actually just did an interesting call this morning. I actually kind of like the company. But once I got into the backstory, the company was formed in 2013 and has been in the wilderness 3 or 4 times on a bunch of pivots. That's pretty negative signal. And maybe the new thing does work. But, me investing in an 11-year-old company is, boy, it's tough. I as much as I was interested in the pitch I heard today, I think that factor is going to make it be very, very difficult for us to get excited. Whereas if the CEO had told me the same story and the company was 3 years old, I would feel completely different about it.
But I feel like most of the founders have like 1,000 different companies from the past. Like maybe they just changed like to a different name or something this year. Like I don't know, like if that's like a good signal, because I definitely seen founders that have like multiple companies, but there's no exit, but there's like a new company here, like
That's
with-
easy to find out. I agree with you, Grace, but that's easy to spot because all you need to do is spend some time with the CEO or the founders and go through their career path. And if this really is name 3 of the same company, you're going to know that in 5 minutes.
What about like the adjacent sector? Like, we all heard about like the WeWork founder that like, originally was doing baby clothing subscription and randomly started WeWork. And like, he had like a bunch of other company in the past, but like, you know, I don't know if that's a good example, but like I feel like I've definitely seen people doing, let's say, called subscription box. Like they've done like, 45 subscription box in different sectors in the past, but like now it's like the new company.
So look, founder market fit is a real thing in addition to product market fit. And I love when I've got a founder in my office is uniquely authentic to the space he or she is building. Really do enjoy that. One of our most recent investments that'll speak in our annual meeting next week, just such tremendous founder market fit. I love deals like that. Now, on the other hand, every once in a while, someone comes in your office and you go, "You're going to do what?" One of my favorite ones of this is a guy named Pete Sullivan. Pete Sullivan started Jackpocket, a lottery company. He sold it to DraftKings earlier this year for $750 million. I will tell you, my first pitch, he walks in, he's built like a bouncer, he walks like a bouncer. He comes in and he goes, "Yeah, I'm from Brooklyn. My dad was a cop and he bought lottery tickets every day." I said, "Why can't you do that online?" I look over, I go, are you the security guy or are you the CEO? Right? Like, I mean, it's just so memorable because he was so outside of central casting, but his founder market fit, you just had to look closely and you saw that it was there, but on the surface you missed it. And I'll bet a lot of people discounted Pete Sullivan in those early rounds because he just didn't look, sound, or talk like a traditional Silicon Valley founder.
Tell me more about like the evaluation of these kind of companies. I feel like my biggest fear of like, let's say investing in sports betting or like lottery or like anything that's related to like gambling, it's a bit of like, okay, what is like the gray area here? Like, coming from like the Asian culture, like there's a lot of like illegalness in like other countries. Um, how do you think about like, obviously it's like very legal in America, but like what is like the thought process on evaluating these like, I guess, high risk, high reward situation? And like, how do you not disqualify someone based off like a one first meeting?
So I think I could argue that I have been one of the most aggressive investors in the entire United States over the last 10 years, investing in sports, gaming, and gambling. I think you'd be hard pressed to put up someone who's done more deals in that category than me. I've always had a rule that I will invest in gray, hope it becomes white. I will not invest in black. And to me, black is very, very clear. So if someone came to me and said 10 years ago that they want to do a sports betting company, I'd be like, nope. But someone 15 years ago came to me and said that they wanted to do a fantasy sports company daily instead of season long. That felt very, very gray. And that was FanDuel, and that became a very successful company. And oh, by the way, we ended up being part of the lobbying group with Chris Christie, who's my neighbor here. I'm in Philly, and Chris Christie was the governor of New Jersey. He sued the federal government saying, how come my casinos in Atlantic City can't have sports betting? We joined in that lawsuit, and ultimately that went to the Supreme Court. And in 2018, sports betting became legal. It got reverted to the states for them to decide how to do it. And something that went from black had become white, and we actually were partially responsible for it. So once you're in this regulatory game, you actually start out figuring out how to do it. My company, Heidu Pataco in Brazil, they actually helped write the legislation that legalized sports betting. They're the largest fantasy sports betting company. Guess what? Nigel Eccles from FanDuel is on the board with me, and we brought the same playbook from FanDuel down to Brazil. Sports betting's now legal there too. So you get good at it at a certain point once you get comfortable with it.
What's like the fascination about this space that you have? Like, why is this like so fascinating to you?
Because I am a gambler. I enjoy gambling. I play on high stakes poker TV shows. You can see me on NBC's Poker After Dark. I myself have always had an affinity to the category. I've never been a super big fantasy fan, but sports betting, casino gaming, always been interested. Always been interested in the intersection of sports, celebrity, and media as well. I've done enough work and have good instincts in it. And as my mom likes to say, I have two sons, and my brother's a doctor. He's like, I have one son who's a neurologist, and I have one son who's a gambler. And inevitably, her friends always say, well, I want to meet the gambler. He sounds like more fun. But think about it, Grace. Isn't venture capital just another example of gambling?
That's too deep of a conversation. I wonder, yeah, like, I mean, like, in your mind, like, how do you kind of like evaluate like what is like, I guess like in a way, like venture capital is like very high risk, high reward subsector of investing. Um, how do you think about the outcomes out of like the gambling, like what is drives you like psychologically that you feel like this is like a that like helps you reach like comfort or discomfort in a way. Like I mean, like I feel like for most people, like gambling may be like bringing a lot of like instant excitement, but like after all, like it's like a lot of like pain in the end because of like, you know, most likely people will lose than like winning. Um, like how do you kind of like justify that? And like what is that like kind of equivalent to like betting on different venture companies? Because I feel like I don't know how you like say the same script to like let's say the LP communities when they're hearing like, oh, we're like betting on everything randomly or like not randomly, of course, but like what's the thought process of like translating the excitement of like gambling to like venture?
So look, I take a very libertarian bent on this, and I think that there are a lot of companies that engage in products that some people have moral objections to. We call them vice deals. Cannabis was one at a time, is less so now. We are actually in a women's erotica company as well. We don't talk about it often for a variety of reasons, but it's also an investment in our portfolio. And it is a category where the customers love the product. And I think if you kick back and just put a morality clause on what you can invest in or not, you have a product that is loved by its audience that would not exist had we decided arbitrarily what our standard of morality was. And so this libertarian view of let all the flowers grow is definitely where I come from. And I will say this, you know, I don't want to delve into the politics too much, but I will say this, as a right-leaning person, I have mentored and coached many left-leaning CEOs in categories and products that might not be ones that I morally am down with. But I feel it is my responsibility as essentially the CEO coach and advisor to teach all people how to build their companies, even if maybe I'm not politically aligned with what the outcome is that that company is seeking. I think that's actually a responsibility for us in the venture industry, as opposed to us just picking and choosing things that we're kind of politically aligned with and saying only those things I will invest in. By the way,
Um,
I think I need a plug for my computer or I'm going to turn into a pumpkin. So can you give me a second?
oh yeah, totally.
Okay. All right, I am back, and
Okay,
I
great.
actually have juice in my laptop, so that's probably a good thing.
Okay. So I wonder how do you pick like your LPs? Like how do you kind of like select them? And then I feel like this sounds like a selection of people that actually would be passionate about like whatever you're passionate about. And how do you kind of like filter out them and then like evaluate like what would be like a good partnership look like from like a venture perspective?
Yeah, look, you want LPs who understand and like your strategy. I mean, ultimately, look, I I tell my LPs we're gonna invest in sports betting companies. We're gonna invest in cannabis companies. I don't want LPs who don't want us investing in those things. And so we've built a really cool partnership with our LPs where they feel like they're getting access to deals they wouldn't otherwise have access to because we're not afraid to go do those categories. I remember one of our big university endowments told us when they invested, now that I'm on your cap table, don't start. Let me get this right. Now that I'm on your cap table, don't wuss out and stop doing the deals you've been doing because I'm on your cap table and you're afraid of what I'm going to say. I was like, that's my kind of LP.
So how do you kind of like meet them and then qualify them? Just because I feel like that's kind of like a unique niche. I'm not sure if it's a unique niche, but like yeah.
It's a sales process like any other sales process, Grace, right? I mean, it's like raising founders always forget that raising money is a sales process. Oh, raising money is so challenging, but I love selling my product. Well, selling the stock of your company, selling a product, same thing. Same thing as a venture fund. It is a sales process, and it is a lot of hand-to-hand combat. It is a lot of one-on-one meetings. It is a lot of late nights. It is a lot of plane flights, right? It's, it's not a surprise. It's all the things you think it is.
Um I guess like when you're like first encountering or when you're first like starting the fund, like how do you find your first LPs? And then like I feel like the strategy back then to invest in like that's like a white space. But right now there's like so many funds that exist like every single day. How do you think about like the differentiation like of people who are investing in like a similar-ish stage?
Almost nobody does what we do. We've had the luxury of being in a very funds, while everyone else thinks that they're just better looking than the person to their left or right. We actually do something different. And the people who do seed extension, post seed, small a, seed prime, whatever you want to call it, are few and far between. When I started the fund, there were about 40 seed funds in the United States. There are now somewhere around 4,000. And I would say that if you made me name you 5 that do what we do, I'd have trouble doing that. I like being in a group of like 5 instead of a group of like 4,000. I don't know about you.
How do you explain like why there's only 5 versus 5,000 in this stage?
I think that is the question I get from my LPs more than any other question. And my answer at this point, I think it's just self-selecting. I think people who go into venture, they either want to be the seed investor and say, I found it, or they want to be the A investor and write the big check. And there's something dead unsexy about doing the round we do in between. And by the way, that's why we call it bullpen. Bullpen's a baseball analogy, right? We're the middle relievers. We're not the closer who's the A fund. We're not the starting pitcher who's the seed fund. We're the 6th and 7th inning pitchers that no one remembers their name, but you need to win the game. That's why we called the fund bullpen. And I think that the unsexiness of what we do is what keeps other venture people away from it.
I want to learn more about like what is the in between picking kind of look like? Just because I feel like I would imagine if someone who needs like a seat extension slash a small A like before the A like pre-A, like I guess like the in between round, like it may looks like a negative signal to like the Series A investor. I don't know if like I mean I'm sure you don't agree, but like um how do you kind of like pick between the seed people to like A to like actually justify that like they actually need the money, they would actually be able to succeed and like all that kind of stuff? Obviously you just said a bunch of factors, but like
So here's something that's super funny. One of the sources of deals are the Series A funds who go, Paul, can you go babysit this for 9 months until it's ready for me to invest? Some of my best deals came from the fund that wanted to do the next round, but knew that the company didn't yet have the metrics to go past the muster to go get the 12, 15, 18, $20 million round. So it's ironic. We actually get referred to as the bullpen, which is the name of the fund. And Series A funds that don't have the metrics yet, but want to do the deal, are happy for us to go do the round beforehand and view that round as positive signal, not negative signal, because we got them to the metrics that they needed to invest.
um I wonder, so like I like that, like that's like kind of like a guarantee for the LP community. Like there's like for sure like a person who is gonna, do the next run. Do you feel like you would have a hard time to find like super quality deals, or like what's the evaluation process in your head about like, or like is this like a 100% that like every single company you invest in will pass on to at least like a Series A?
Our
What's the
gradu-
graduation rate?
our graduation rate has been around 70% since the inception of the fund. And that is a number I'll put up against any other fund, right? And obviously market conditions change a little bit, and so certain funds have different vintages, and the follow-on capital is harder because the market's different. But we've run in that number around 70%. And think about it. I'm taking a deal that might be viewed a little bit as a slightly ugly duckling and turning it into a consensus deal on the backside. So we had this phrase, we called them pre-consensus deals. So if I can 7 out of 10 times turn a pre-consensus deal into a consensus deal that the A people want to do, I got a good business.
Um, how do you raise your first fund? Just because I feel like that's such a unique strategy to communicate to like the LP community. Um, how many people have to pitch for the first fund to actually like close on this strategy?
So the first fund was back in 2010 and the closings were in 2010 and 11. The first $4 million is all we had. We had $4 million. It was me, Duncan, and Rich. Duncan Davidson and Rich Melman. Rich Melman, the founder of Electronic Arts back in 1982. Duncan Davidson, the founder of Covad back in 1996. We had invested as angels together. We put together $4 million, just us and a couple of our buddies. We acted like we had $40 million. We literally were writing term sheets for $2 million rounds. We were putting up $200,000 of it and acting like we were a bigger fund. We did a second close that got us to 8 million, and we did a third close that got us to 24 million. And what happened is in those second closes, we had a couple companies in the fund that were already kicking butt. And so we were able to parlay our experience on 4 to 8 to 8 to 24. 24 is ultimately what it ended at, $24.5 million. And had we waited to get to $24 million to invest, we would not be on this phone call. We would not be on the Zoom because I would have never been in business. And so this kind of rolling close, beg, borrow, steal is exactly what we did. And it was kind of unusual in 2010. I think a lot of the new funds figured out that this is a good strategy and let the later people in, give them a little bit of a spiff from some of the early deals, and everybody's happy.
What was your first deal?
The first deal was a Sistly. It was from Phil Black at True. In the early days of the fund, we were brainstorming with 3 or 4 people. Phil Black from True, Josh Koppelman from First Round, and Mike Maples from Floodgate. We're saying, look, there's going to be this problem in the future where so many seed funds are going to exist, and you're going to have companies that you like but aren't ready for an A. What are you going to do with them? And we literally did a road show among all of the kind of seed funds. There were about 20, 25 seed funds at that time. Iden over at Felicis and a couple others, right? I mean, literally, you could name all the seed funds in the United States on like I said, somewhere between 20, 25, maybe 30 if you count generously. Phil Black calls me up one day. He goes, "Okay, Paul, enough brainstorming. I got a deal. Love this deal. It's in the customer relationship software side. It's called a Sistly. They don't need a ton of money. I love the deal. Go issue them a term sheet. I'll pile in as the insider. And the company then can either go raise a big growth round or can sell." 9 months afterwards, it got bought by Salesforce. It became Desk.com, which is still Desk.com to this day. That was our first deal. And it was Phil Black calling us up saying, "I have the deal that's going to prove your model." And boy, was he right. And we forever owed a debt to him for sending us that. Alex Bard, the CEO, by the way, is now a venture person himself over at Redpoint.
Oh, wow. So when you were putting together the money, like, was it a lot of like gambling to you, or like was it just like you really trust like the True Venture Partner team to be like, okay, they've done the diligence here? Like, was it like do you feel like it was luck, or like do you feel like it was more of like I actually did my diligence too? That's like the
Oh, absolutely. You need to do both pieces of it. I mean, anybody who thinks that it's all skill is full of it. Anybody who thinks it's also all luck is also full of it. You need both art and science. You need luck and you need work. You need them both.
Have you so did someone else send you a deal that you passed up on at the very beginning? Like
Oh,
you're like,
sure.
yeah,
Oh,
like
absolutely. Oh, sure. And I'll never forget one of the people who I was brainstorming with, who will remain unnamed, sent me a deal that I viewed as a turkey. And I remember calling him up going, No. Bullpen is not here to go save your turkeys. It is here to go grow your winners that are just a little bit away. So don't send me another one like that.
What was like the early on processes that you're like judging this one is a turkey versus like not?
Again, it's the stuff that I'm talking about: product market fit, early evidence of scale, capability to bring in some money to accelerate growth. It's amazing. Great. 15 years later, I've been in business 15 years now. The scorecard is almost the same. And you know what's amazing to me? I've now, as I said, I've been a 9-time founder. Bullpen is the only company I've ever done as a founder where what I'm doing in year 15 is identical to what I was doing in year 1. The only one. And for as dynamic as the venture ecosystem is, it's amazing that we're doing the same thing 15 years later. I remember, by the way, I pitched Reid Hoffman when he was at Greylock on this fund strategy. It's funny. I remember he went up to the whiteboard, he thought about it a little bit, and he was like, Paul, your idea is very good. I have no doubt that there's going to be an impedance mismatch between seed and A, but it's an arbitrage that'll go away quickly, and you'll do 1 or 2 very successful funds, and you'll be out of business. By the way, he could have been right. It turned out he was wrong, and the gap is even bigger now 15 years later than when we did it. But his idea was not unreasonable, that it'd be a short-term gap, it would go away, and it would get filled by the rest of the funds. Turned out it didn't happen that way.
Why are these company actually need a little bit more money versus like just go ahead and raise like a Series A? Or like, I mean, like I know that their metrics, there's like something lack of it, but like,
But there's also another piece to it, Grace. Sometimes they actually have the metrics for the A, but they'll get the shitty A now, and they'll get the good A year from now. Some of the CEOs I love most that come into my office go, I have a bad Series A term sheet. Why don't I do a small round with you instead and go back to them in a year? Oh, I love deals like that. Because again, it's continuous. It's not discrete. Even though the rounds are discrete, the metrics are continuous. And so if you can go from a company that's raising an $8 million crappy A to a $20 million spectacular A because you do a $3 or $4 million round with me, that's a lot of the cap table you save if you do it correctly.
so what would be your like evaluation compared to the prayer run and like later runs?
So we actually, we haven't looked at that in a while, but in the early funds, we track that very closely. The premium that we pay to the prior rounds in, call it pre-COVID, right? Because I don't think this is a stat we've tracked. The world is so different post-COVID. We had that one weird year in 21, and then we've had the 2 down years in 22 and 23. So I don't think we've tracked this number. But 2020 and before, the premium we played was 20% to 80% more than the prior round. We would never pay more than 2x. We'd never need to. And we'd frequently be in a spot where a little bump, like 20-ish%, made a lot of difference to the cap table. Now, the world's different, and we have done down rounds now. We've done sidewards rounds. We've participated in recaps. We ourselves don't like to do the recaps. We will participate in them if the CEO leads them. But the world's different, right? We went through the first 12 years of the fund in a bull market. We went through the last 2 years in a bear market. So those metrics will be different now.
How do you come up with like the valuation? Is that just like whatever the founders need, and then like I don't know, like I feel like I asked the same question again, basically, but like I guess like what's a formulation of like creating some sort of like valuation for it, and like
There is,
that kind
I
of
can
stuff.
tell you this, our round is so specific between seed and A that there is a very narrow band where the math works. And so without going into the details or kind of almost some of the secret sauce to it, what's amazing about it is our valuation discussions with our founders are frequently not contentious. It's, look, I'm going to show you the math. If you do the round here, this is what the next round looks like. Here's where you were before. And sure, maybe there'll be some movement, 10% here, 15% here, but ultimately there's a very narrow box that a bullpen round fits in. And it actually leads to very little negotiation of valuation, because if you go to the left, it's a traditional A, and you go to the right, and it's just another seed round. So it's actually very funny how easy it is to deal with the valuation part of the discussion in our term sheets.
Have you like kind of like calculated and then feels like certain deal is like a hard pass because of like it doesn't make sense to invest in? I'm sure there is, but how do you kind of like how many deals do you have to see to get like a like just like a gut check or something? Just because I know that you guys are doing something super specific, so the people who came to you, it's like more specific than usual. Um, Compared to like a regular like seed or series A round, like what would be your ratio of like investing in people? Is that like you came around like maybe like there's like only 500 people actually go to you every year and then you pick like 10 of them versus like the 5,000 deals or like 5 trillion deals everybody else
So,
were receiving?
so our funnel's got two stops. Our top of the funnel is everything. And then the first stop through the funnel is stuff that looks conceivable. Have they raised less than 3 to 7 million? Are they burning this or this? So there's a first level screen. That first level screen takes a 0 off. And by the way, I could train somebody in an hour to do that first level of screen. Literally, I could take any person listening to this podcast and in 1 hour, they would know how to do the level 1 screen. So I don't know what the numbers are. Let's say it's 5,000 in a year. That 5,000 becomes 500 in 5 minutes of screening. That 500 is where it gets interesting, though, because let's say you've got 500 over the course of 12 months. 12 into 500 is 40. That's pretty cool. You got about 40 deals in a month that you can go spend some time with and figure out if they're useful. And at the bottom of that, maybe you do about a deal a month. Our pace has usually been about 10 deals a year. So 500 to 40 to 1. And that 40 to 1, that's where all the action's at. That's where all the hard work is.
Do you require to see their like basically like the deal detail or something right away? Or like how like walk me through the conversation of you and the founder. Is that just like the couple things that you mentioned to me, like about numbers of employee burn rate, like prior financing? So like you sent an associate there and then like they kind of like took notes on like Excel sheet and then you'd be like, oh wow, that's like amazing. Okay, here's all the data. How do you evaluate? Like how do you like kind of diligence
15
the
minutes.
data?
I'm just telling you right now, 15 minutes. If I'm going to tell you right now, if me or an analyst or an associate, and I don't care if it's me, the most senior person in the fund, or a most junior person in the fund, if after a 15-minute discussion, we can't qualify it as a potential bullpen deal, we probably don't want to invest because the CEO is being evasive, right? So there you go.
And like I guess the other problem is like how do you kind of like diligence if what everybody said were like the truth? Like I feel
Well,
like the
again, though, those metrics, though, it's very difficult to lie about. How many employees do you have? Great.
okay.
CEO lies to me about how many employees they have. Well, how's that going to go once we start talking about a term sheet, right? These are verifiable. These are not judgment call questions, Grace, right? These are black and white questions. How much are you burning? How much did you raise? How many employees did you have? Right? It's like if you're going to try and bullshit me on those in the front door, this ain't going to go anywhere. So it's kind of a self-fulfilling prophecy then.
Um so after that, like how do you like let's say if in a particular month you're getting like 40 of the deals that are like all qualified, do you just invest in 40 of them or like do you just do like one
No way.
a
No
month?
way. You can't. You cannot do that. Even if you had 40 deals in a month that were over the bar, you're going to pick your best deal in that month. And in some months, you're going to pick no deals. In some months, you are going to pick 2 or 3. And so you end up at about 10 a year. But that 40 goes down to kind of, there's a step in between, if I'm really being clear about it. That 40 goes down to call it like 3 to 5 before it goes down to 1. Right. And those are the ones that go to the partner meeting. Those are the ones that we've really, really spent the time on. Those are the ones we built our own economic models for. Those are the ones that we've looked at the Excel spreadsheet the CEO's running the company to and say yes or no that we believe the plan is hittable. And so that 40 goes down to 3 to 5. And then, we do the more traditional partner process at the back end to see if any of them make it over the bar finally.
What does like the processes look like to you mentioned about like obviously I guess you go back to who is leading the run and stuff like that. Does the superstar leading the runs are like generally tend to be better, or like so basically meaning like a name brand, let's say like a name brand that like people or like you have heard of, or like everybody else have heard of, like leading a deal that's like going to be a better deal later on, or like is this like not?
It's all over the map. So sometimes, obviously, this is a branded business. The better the progeny of the deal in terms of the investors, the better signal it's going to have. But a lot of times there's an indistinguished seed fund you've never heard of in a weird part of the United States that has one really good deal nobody's paying attention to. Those are some of our best deals. FanDuel was a perfect example of that. It was the best deal in Scottish Enterprises portfolio, right? And no one knew who Scottish Enterprises was because it was a seed fund in Scotland, but it was their best deal. And that ended up being one of our great deals because it was the best thing in their portfolio. Sure, we've done deals that have been first round deals and floodgate deals and true deals, you name it, all the big branded funds. And then we've done the best deal in Scottish Enterprise fund too.
What are some other stuff that you would screen to like go from like 40 to 1?
By the way, I think that might have to be my last question. I got to get going
Okay.
here
Yeah.
to a call here. We're
Yeah.
almost on
Sorry,
an
I
hour.
forgot the time. Yeah.
Yeah.
So
So I think so. Let me do this one, and then you get one final question. By the way, this has been great. Thank you so much for all the time. So that's where it gets hard. What I mean by that is that's where we have to start really making hard judgment calls as opposed to quick screening calls. Is this a category we want to be invested in? Is this a founder who can take the company all the way to be public? Is this a space that has the hallmarks of rapid growth that we're going to want to see for the next investor? So there are some really hard, what I call judgment-y type calls that need to happen. See, that's my next call here. I got to tell you, I'm going to have to take that in a minute.
okay.
Those are the hard ones. And those are some of the things that happen when you go from 40 to 4. All right, Grace, last question.
Okay, 1 minute fire round. Favorite book?
The Burden of Bad Ideas. Go read it. It's a good one.
Dinner party guest.
Dinner party guest. It got to be Matt Acco. Go hang out with Matt Acco, dude. He's a trip.
Who made the biggest impact in your career?
Bill Campbell's high on that list.
Where can we find you outside of work?
Oh, dude, you name it. Poker table, casino, Los Angeles, where I spend the other half of my time with my new nightlife business. You can find me all over the place.
Amazing. Paul, thank you so much for coming to the show. I'll let you take the call.
Grace, thanks for the time. I'll see you again soon.
Okay, see you soon.